Good evening, all, and welcome to the Stearns Financial 2022 update on the economy and investment markets. I'm Haleh Moddasser, and I'm joined here tonight by our esteemed panel, Dennis Stearns, PJ Williams, and John Thomas, all of whom are members of our investment committee. Welcome, gentlemen. So 2022 was an unsettling year for many reasons, not the least of which was our ongoing battle with the Omicron variant. We continue to experience political gridlock, higher inflation, supply chain issues, work from home, the Great Resignation, just to name a few. And yet the markets ended the year in double digits. So what do you think has made the market so resilient? Dennis?
Well, I think there were a number of things in 2021 that went right, and we actually dodged some bullets, threaded the needle again. Everybody may remember in the mid to late part of 2020, there were a lot of things that had to go right to get us through to where we were, and they did go right. 2021, very similar. I think corporate earnings being very strong. Talk about resilience, the bounce off the bottom from 2020 lows, pandemic lows, partially due to companies doing what they always do in messy times. They cut costs, but one of the big differences was they did a very big digital pivot. A lot of companies to spend more on digital marketing, digital applications, automation, artificial intelligence. And so the increase in free net cash flow was significant, and that showed up in valuations in 2021. However, some areas probably got a little bit over their skis, and we'll talk about some of that. But the other thing that we highlighted in one of our chats recently that could have caused the year to turn out very differently was if the corporate tax increases were still in the mix for 2022, because that reconciliation bill had those corporate tax increases originally front-end loaded. And, as we pointed out in one of our recent chats, that could have easily made the 5% September correction in stocks be 10 or 15% on the downside, which would be a normal correction. So not necessarily abnormal, but the fact that lobbyists got in there and helped change the course of some of that, and in addition to some of the political gridlock, that was very beneficial tailwind to the stock market, US stock market in particular.
Yeah, agree, Dennis. And even though a lot of companies are seeing wage increases and supply chain issues, like you mentioned, the technology and online buying and just being able to bypass retail establishments and have fewer staff working has really probably picked up some of that slack.
Well, and never underestimate the ability of companies to figure out workarounds. And so, one of the things that happened with companies hiring their own ships when they saw those ships sitting off the port of Los Angeles, they hired their own ships to try to do workarounds. And that's only a tip of the iceberg of the workarounds. So some of our clients are supply chain managers. And if you're listening right now, kudos. And I know it's felt like it's been 5 years in 1 year.
Indeed. JT, what do you think?
I think absolutely the earnings buoyancy is a big part of what explained the capital markets doing so well. I think we've got to obviously keep it all in context. We're talking strictly about financial, capital, economic factors, which were remarkably strong, even in the face of still horrendous human losses from the virus. Again, as we were thinking about, kind of election time of 2020, that was really when the vaccine news began to come forward, and it became much more clear that we were going to be able to mitigate a lot of the risk of the virus through the vaccine rollout. And obviously there were lots of fits and starts. There's lots of things that looking back, we wish we could have done better. But that was the turning point in allowing for enough reopening, enough of the type of things that Dennis just described, resiliency and supply chain and profit growth, to allow the markets to respond. Clearly, there were a lot of unprecedented actions by government that fostered and encouraged that, whether you're talking about the health rollout, but certainly also on the economic side, the unprecedented actions by the Federal Reserve to increase their balance sheet, to keep the interest rates at exceptionally low levels, and all the stimulus and other payments, which we certainly will address as a potential risk factor going forward, and how do we work our way out of some of this debt. But in terms of building that bridge to allow American consumers to maintain their spending power and therefore propel the economy higher, those things added up, and that was what the market really took to through 2021.
Yeah, agreed. So far so good, right? Not every asset class, however, did beautifully. So PJ, why don't you talk us through actually what happened last year with the various asset classes?
Thanks, Holly. And so looking at this first slide here, we've shown this many times throughout the years. It comes from JP Morgan, and really what we call it a periodic table, if you want to go back to science class, or an asset class return quilt with lots of colors. But what we're really looking at here is going back to 2007, the annual performance for a variety of asset classes each year. And what you can see is following the colors across, that many times an asset class that might be at the bottom for a couple of years might rise to the top, and vice versa. And so focusing in on that third from the right column, which is looking at 2021 performance, you can see that the best performing asset class last year was REITs, and those are real estate investment trusts, up over 40%. Now that is on the backs of a year in 2020 where they were down, in the worst performing asset class here that we're looking at. Going back to 2020, we know that there was lots of concern about offices shutting down as we began this process of working from home in a whole new world and a new working environment. So there's pressure on REITs during 2020. Lots of tailwinds last year. When you think about why REITs did well last year, you're looking at their dividend yield. Many investors are seeking out dividend yield, and in the US stock market, the dividend on the S&P 500 is around 1.3%. Buying REITs, many times you can get closer to 3% dividend yield. You're looking at another tailwind being inflation. Real estate prices have increased significantly when you're thinking about multifamily apartments. Many people, single family homes have appreciated a lot. You're looking at industrial warehouses when you think about e-commerce and it becoming a bigger part of the US economy. Those areas definitely did well last year, and inflation was a part of that. When you're looking at other asset classes and we look at equities, you can see a very wide range return for equities last year. The best performing equity market, looking here, the large cap in the green there, that is the US large cap stock market, the S&P 500, up almost 30%. But you look at the bottom down there with emerging market equity coming in with negative returns. And so again, on the large cap space, we'll talk about this a little bit later, but technology names really drove that with lots of strong performance from technology. Also, we had energy names come back last year. You look at commodities, they're the third asset class down. Oil, natural gas last year had a strong bounce back. Now, again, that's great for the returns for these companies that are focused in those areas, but it might have other negative effects in other parts of the economy. When you think about higher gas prices being a potential headwind to US economic expansion. Another asset class here that many of our clients own is fixed income. Again, we've talked about this before, but as interest rates rise, fixed income prices fall. And so we saw upward pressure on interest rates last year. But again, we're seeing even more so early part of this year, the sharp rise in the US 10-year, which has already gone from ending the year at 1.52% to around 1.8% today. And again, that's a pretty sharp rise and has produced negative year-to-date returns for fixed income. So again, the ultimate thing we always want to talk to clients about is the fact that building a diversified portfolio keeps you in the middle of these returns. You're not betting on all on one asset class. And so you look at what is a white box there in the middle, light gray, that says asset allocation. And that's a JP Morgan asset allocation, diversified portfolio with about 65% stocks and 35% other asset classes, fixed income, commodities. And you get to a low double-digit return last year. So a very strong performance despite everything that Holly talked about that was going on in the US and around the world.
Yeah, I know when I meet with clients, they're exuberant about their returns, but I'm starting to sense a little skepticism as well. I mean, if you turn on the news, the political gridlock, the spending that we've had, how expensive are stocks really right now? JT, talk us through where you think valuations are in the US and what that means for the future.
Sure. Yeah, thanks, Hallie and PJ. It's a great question. How expensive are stocks really? And I think, this chart attempts to portray, it's looking just at a 25-year history, and there are a number of measures in the table at the top. The graph shows the classic price to earnings ratio, looking at expected next year earnings, which are expected to grow quite well. And yet you can see that the valuation is elevated. The question is how far? In an environment where we had exceptionally low inflation and interest rates, you could rationalize some of these higher valuations perhaps because those future earnings were worth a lot when you didn't have much of a discount factor. As PJ just described, with interest rates beginning to move significantly higher, that begins to erode those very long-term future profits and what is the value of those today. So you've actually seen the price to earnings ratio come back down a little bit, partly because of those interest rate factors, partly because earnings have just been very, very strong. Nonetheless, by most historical measures, you can see that there's so-called at least one standard deviation higher. They're at least one, significant increment higher than their long-term average. So this is notoriously not a good timing tool. It doesn't tell us when we need to get in or get out of stocks in a specific way, but it's something we need to keep in the back of our mind that, starting from more elevated valuations like this definitely puts a headwind or puts a thumb on the scale in pushing down our expectations of future returns. So that is one of the things that we have to consider as we look ahead over 2022 and really well beyond as well.
Yeah, and I think when we look at corporate earnings in general, so much of it is driven, and this whole conversation started with the COVID factor. That's impacted supply chain, it's impacted wages, it's impacted the number of employees there are. I know I drive by fast food establishments and they're closed because they can't find anyone to run the register. So let's spend a minute, if we could, Dennis, on what's going on with COVID. Where are we in this pandemic?
Well, so we're in a better place than we could have been. And, again, I think the really great situation we have combined with some really awful situations is that the vaccines seem to be working to, even though a lot of hospital systems are overwhelmed around the country. And we hear that daily, sometimes hourly, from our clients who are in those systems that it's not fun right now because they are overwhelmed. A lot of the people in those hospitals are unvaccinated people getting the new strain. The good news is the new strain of COVID isn't killing too many people, although there were just 2 stories today about 2 people that it killed. And so, but it's not as bad as the Delta strain killing the unvaccinated folks. Of course, the other problem that we've talked about in chats and elsewhere is that it's causing a lot of surgeries to be put off. And in general, people aren't going in to get their physicals. They're concerned about getting sick, even if they won't kill them. People just don't want to get sick. And so they're putting off physicals. And as we've talked many times before, there are multiple things that if you can catch them early, and we're talking everything but COVID, including many cancers, if you can catch them early, they can be treated or they can be slowed down. And so that's one of the worries that we hear all the time from healthcare professionals is COVID may not be the biggest problem right now that we're going to be facing 6 months from now and 12 months from now. It's going to be those things that should have been diagnosed but aren't.
But it's tough, as you know, Dennis. I know my mother, who's in her 80s, was showing symptoms of COVID. So she has a heart condition. She's in her 80s. She lives by herself. She called her doctor, and it was going to take 3 days for her to even make an appointment to get a test. And then it took another 3 days for her to get the results back. So for someone in their 80s in that condition, 6 days is a long time to be waiting. Thank goodness her result came back negative and she just had a cold, but this is really taxing our healthcare system tremendously. So it's hard for people to get in and out. But what I'm hearing is, as quickly as this Omicron came to fore, hopefully by March, we're kind of past it. So hopefully there's not going to be another variant, but at least we're moving right along.
Well, that's right. And, I was on a briefing call with a airline CEO yesterday, and every other sentence was assuming that there's not another variant coming in behind Omicron. And I mean, after a while, it actually got a little tiresome because basically he was saying all bets are off if we get some other variant. But yeah, most of our sources and most of the health officials believe that we may be moving from a pandemic stage into an endemic stage. Doesn't mean it's not still dangerous. And again, this chart demonstrates on the left how fatalities, there still are fatalities. I wish that black line would go down to 0. So again, this says that, there are still people dying, but it's not spiking up the way confirmed cases are, which is the blue line on the left.
Well, fortunately, as we all know, this Omicron is highly transmissible, but less serious. And so the upper chart on the right is showing that 95% as of January 1st of the COVID test results are coming back as Omicron.
Yeah, and the other thing that I should mention is we've had even some clients and friends of the firm who got the original COVID, got vaccinated, got boosted, and got Omicron. Yeah. And they described it as a bad 2 to 3 day flu in most cases, but they still got it. And many of the experts we tie into, they're not 100% sure that if you get Omicron, it's going to give you these, so-called immunity against future strains. I mean, clearly that didn't work with one of the original COVID strains. So again, this may just become a chronic background noise that we're going to have to deal with perhaps forever.
Yeah, it definitely doesn't feel like we're going to shut down economically the way we did in March of 20. So
very unlikely. Yeah.
Very unlikely. So we'll keep masking and keep monitoring, but hopefully we're not going to have that kind of shock to the system that we did before. And obviously there's a lot more than COVID that's impacting how the markets will do. The supply chain issues and wage issues. Inflation, in fact, ended the year in 2021 up 7%, which even in our bear case scenarios last year that we did, no one came close to that number. So it was a shock, I think, for everyone. And, the Fed has indicated that they're going to stop their asset purchases, and then they're going to start raising rates maybe 3 times next year. Last I checked, they're still buying assets. So what's the likelihood, JT, that the Fed will get this right? It's not an easy needle to thread, I know.
I think that is a very apt analogy of trying to thread the needle. And I think, when we talk about inflation, there's still a lot of basing effects that we're looking at when we look at the year-over-year inflation factor of 7%. We had such a downturn in 2020, measuring from there to the end of 2021. has perhaps an inflated inflation figure, if you could say such a thing. If you look at inflation over a 2 or 3 year window, it's still relatively benign after this bounce back that we've seen. But it is certainly a very pernicious risk as we look ahead into the future. So let's see if we could pull up the slide that's looking at the Fed funds rate and Fed fund rate expectations. Interesting to note that just as recently as perhaps 90, 180 days ago, there wasn't an expectation for the Fed to even act in 2022. Now we're up to 3 rate increases being baked in, and now more and more looking like it could be 4. So, the Fed is going to be, they're clearly on the case. They're communicating very often about what their trajectory is to try to prepare markets for this. But what are the odds that it all goes smoothly? That's really unknown. And I'd say, looking at historical analogies, when the Fed does start moving, there tend to be some dislocations or disruptions in markets. It doesn't go just as everyone expected. Even when you know it's coming, somehow there tend to be some disruptions that occur in the market. So it is widely anticipated. They should be able to address it. But again, the history is that they either do too much or too little, and it's hard to get that Goldilocks formula quite right. So it is a healthy process. We're all anxious for the Federal Reserve to be able to raise interest rates. That's an indication of the great progress in the economy and the market being able to sustain more normal more normal interest rates. Once that occurs, the capital markets actually function better, and inflation, at least from a investment perspective, tends not to be too problematic until it sustains above, say, a 4 or 5% level. And I think broadly the outlook would be that as the supply chain rectifies, as we have more folks coming back into the labor force, perhaps, we're going to see a lot of the inflation dynamic moderate. Probably not back to where we were. We may see more sustained inflation in the 2.5% to 3% range. But back to some of Dennis's original comments, that's a level at which the C-suite, leaders of businesses, capitalism generally, is able to adjust to that level of inflation and produce very good economic results, good profits.
Well, the classic definition of inflation is too much money chasing too few goods. So we've talked a lot about supply chain and how and wage inflation, not enough workers, not enough product. But there's also a pretty cash-rich consumer out there, which has created a lot of demand. And I think there's a lot of pent-up demand because they've been trapped at home, unable to travel, not able to go out to dinner. So let's take a look at consumer balance sheet and just see what's happened during this past year. Dennis, you want to walk us through this?
Sure. And so longtime watchers will recognize the chart on the upper right, the household debt service ratio. And that ratio after the Great Recession of 08-09 came down radically and has never really gone back up. So what that suggests is consumers have a lot of ability to spend money or get credit to spend money, or both. And they're actually doing a lot of both. And so there's a significant amount of cash that has built up. It is measured in the trillions of dollars. And that is part of that chart on the left-hand side, but it's actually a fairly small part of that chart on the left-hand side. The other assets have all buoyed up very nicely. And again, if you look down at the bottom right, you see that since the high of 07, and then it dipped down with the Great Recession, which was pretty nasty, we're now up to a very significant increase in household net worth, $150 trillion of household net worth. And so, generally people are feeling wealthier, but I'm not sure that even matters much. People, back to your comments, Holly, people are just generally fed up with the pandemic. They're over the pandemic, even if the pandemic isn't over them. And yeah, there's just so much pent up demand that we think that'll be a healthy tailwind for the U.S. economy in particular, but the global economy in the next year or two.
Yeah, it is pretty remarkable. While I agree that we're all pent up and dying to travel to Europe and go out and do the things that we used to do, these numbers are remarkable. I mean, like we've more than doubled the household net worth, which is just huge, right? And so I do think that if you feel rich, your investments are doing well, you've got more money, you've saved money because you haven't been going out, you are more likely to demand more products. And I know that we've seen just purchasing online or home renovation and house prices, people wanting to update their offices at home and adjust to this new thing. I mean, there's still spending going on, even though it's shifted the kind of spending that we've been doing.
Yeah, absolutely. Just try to get a contractor to come to your house in a
Yeah, I
timely
know.
fashion.
I mean, windows for houses are on back order for over a year, so you can't renovate even if you want to.
I think it's important to acknowledge that a lot of that household net worth, I mean, we've talked in the past about how that it's very stratified, who has really benefited. And there's definitely a lot of that's the case. There's a lot of the have already getting a whole lot more through this process as financial assets particularly have performed well. But it's also true that a lot of those consumption patterns are more robust kind of up and down. And some of that's back to the transfer payments. Again, we can talk about the good and the bad of that, but certainly the folks who are more reliant and see a much bigger benefit in their marginal ability to spend when they have actual cash in their bank account. So, that again can be sustainable for perhaps a good part of 2022.
Yeah, agreed. It's good to know that the consumer is doing well, but maybe not as exciting to look at how the U.S. government is doing. So let's look at that balance sheet, PJ, if you would. Talk us through what's going on there.
On this next slide, you'll really see a stark contrast to what we just looked at with the overall consumer doing well. Again, JT mentioned that's not everybody, but the overall consumer is doing better in the U.S. If you look at our federal government and how our balance sheet for the U.S. looks, things are definitely not headed in the right direction. If we look on this slide, the top left, we're showing how much the U.S. is spending each year versus how much it's bringing in, and then on top of that, having to borrow. We know on the left chart there that the bottom part of that, Medicare, Medicaid, Social Security, and a large part of the defense budget is going to remain there and may continue to grow as baby boomers retire and more start collecting Social Security and more people are on Medicare. And then the right side, again, is based on really what does the U.S. bring in? The largest part of that is tax receipts. But again, we're still showing on this chart about a $1.2 trillion shortfall. And so that means every year, on top of our existing debt, we're borrowing an additional 1.2 trillion. When you think about our gross debt today, around 30 trillion, with the net debt being around 23 trillion when you adjust for assets of the federal government, such as gold, you end up with, we are still increasing the overall amount of debt by almost 4%. And so that number is pretty large when you compare it to our GDP growth. And so the bottom right chart there is showing the federal net debt as a percentage of GDP. And you can see in 2021, we hit pretty much 100% for the first time since the end of World War II. And so the question is, what's it going to look like the next 10 years? Are we going to see anything like what we saw after World War II, where there's a sharp decline for the next few decades? Or are we going to kind of continue where we continue to borrow, GDP grows, but doesn't grow as fast as our borrowing, and we see an uptick in the federal net debt as a percent of GDP? When you think about going back to post-World War II, what enabled the U.S. to go from over 100% down to closer to 20% when you're looking at net debt as a percent of GDP? A couple of things. One thing was that we did have some very strong growth years coming out of that. We did have another war the next decade, but that war, President Truman wanted to finance it mainly via taxes and wanted to try to maintain disciplined fiscal policy. The question is, looking at where we're at today, coming on the backs of some large borrowing years as a result of the COVID pandemic and trying to jumpstart the economy, will we see agreements in Washington that push for that fiscal discipline. I think we'd all agree, most of us would agree right now that we're not seeing that given the political gridlock that we're looking at. And so as a result of that, this number may continue to increase. Again, what does that mean for the economy? And this is where there's a definite multiple theories out there for this is going to at some point damage the US dollar. Again, the US dollar, even while debt was growing last year, the US dollar had a great year relative to other currencies around the world. But the question is, as a result of this, at some point, does that roll over and the US dollar face some headwinds? And I think the other question is, what does this mean for inflation? How much is the federal balance sheet driving the high inflation, or is it, like Holly mentioned, too few goods for the amount of demand that's out there, and on the backs of the supply chain issues? So there's lots of theories on what's causing this, but the question is, can we either have faster GDP growth to get this more under control and trending downwards, or can we have a balanced budget? Over the last 50 years, outside the late 90s and early 2000s, the Clinton administration, been very few years where we've had a budget surplus.
And I think maybe just building on that, we all know it's a problem. I guess we're all running a great experiment, unfortunately, in that we don't really know what that ceiling is. When does the market start to have a problem with this level of debt? After 2008, the financial crisis, and again, after the COVID health shock, the federal government stepped up, maybe appropriately, to bridge that gap. But the real problem is we've not had the political incentive to address it on a conscientious basis. And so, looking ahead over the next decade, we'd all, I think, agree it would be much better for us to get ahead of this by making appropriate fiscal changes so that we can see that coming down in a substantial way before the market has to react and impose that discipline on us from external sources. That's obviously a matter for a lot of political debate and a lot of different viewpoints represented, both on this call and externally.
Well, and it's much like our financial roadmaps. You'd like to see a margin of safety just in case bad things happen. And so we are losing some of our margin of safety. And so, maybe it's not a clear and present danger, but it is an ultimate danger as we move out in the next 5 or 10 years. I'll also mention the super trend impact on the budget. We've had some really interesting people that we've networked with who are looking at either potential tailwinds on the budget or headwinds on the budget. But we're constantly reminded that the increase in Medicare costs that is baked in, technology could bring that down substantially from what's actually baked in to that estimate. And the pandemic accelerated diagnostics, telemedicine, all the diagnostic pieces. I mean, 10 years ago, did anybody actually think we would have a EKG on our wrist in an Apple Watch? And the things that many of our clients are working on actually are just amazing that are coming up that will be lower cost, particularly in that last 6 months of life for Medicare and Medicaid. So again, I think you take some of the long-term forecasts with a grain of salt and you see how some of these other things play out.
Maybe just one more quick note on that. The best way to solve that, because all of the figures BJ was representing were as a share of GDP compared to GDP. The best way to solve this is to grow that denominator, to grow that GDP at an above average rate. And that also is obviously subject to debate. Will things like the infrastructure spend and other things, investing in education, will they allow the productivity of the US economy to be improved enough to help address some of these debt questions? It's an open question.
It is an open question, JT. I do think on that slide we were just looking at, the Congressional Budget Office in the bottom left has their forecast for the next decade. And they are showing that they expect growth to slow down back to below 2% real. And again, real is after we adjust for inflation. So we're going to need a surprise to the upside, or again, more fiscal discipline to kind of get this back under control.
Well, on that positive note, let's assume for a moment that there remains political gridlock and we have a hard time getting the expense side of the equation under control and focus a little bit on GDP and jobs. So we're seeing a lot of changes in jobs as a result of this pandemic. I think some of it is potentially here to stay. I actually read a study where someone estimated that 51% of workers will never go back to work full time. And I know we've seen, or back to work in the office, I should say. And I know we've seen acceleration of boomers retiring. We've seen kind of an uptick in the gig economy. How is it, I wonder, that we have so many people and companies looking for jobs when the unemployment rate is so low? JT, you want to tackle that question?
Well, again, that is going to be a big part of the dilemma for businesses over the next year, is how can we meet demand? And that's the wonderful thing, is that there seems to be pretty robust demand. You're hearing that from a lot of the earnings calls. That I think I heard that CEO confidence this morning is the highest perhaps it's ever been. So there are a lot of companies trying to expand what they can deliver, but we're constrained by the amount of workers, and appropriate workers, workers with the right mix of skills, education, background to meet it. It's a bit of an irony. I think we've been joking for years about the artificial intelligence, the age of robots, and the concern that the machines are coming for our jobs. And here we've got the opposite issue. We need more of the humans to run the machines so that we can get all that we need out. One of the potential ways to address or rectify that is going to be more folks coming back into the labor force. And that's what's kind of portrayed here, particularly at the bottom right, the so-called labor force participation rate. You can see a huge drop related to COVID, and things have come back up significantly. The overall labor force participation rate is now approaching 80%. I'm sorry, on the left-hand side of the scale, approaching the 62%. You can see the long-term average being more like 63. What's a little bit more striking is the prime age workers, so-called 25 to age 54. And you can see that gap is still material. What this represents, it doesn't look like a lot on a percentage terms, but we're talking about over 2 million workers that were working, that were employed, that were pulling in paychecks, were contributing to spending pre-COVID that aren't today. That's a pretty significant gap that could go a long way to fill some of these needs, particularly in the service economy. I think it's a real interesting perspective. I mean, Holly, you talked about a lot of these may not come back in the same way. Some of the changes we've had to make through COVID have actually improved the efficiency of the labor market. You can do a much better job of matching needs and skills if you can do it through these online tools like we're participating in right now. If you can do it through, offering that gig type work where it's a certain number of hours, or you could pick up hours in a lot of different ways online, or through offering them not having to make the same sacrifices. So, that helps the efficiency. It helps make those hours worked more productive. Folks are able to command a little bit higher income by doing so. Best guess is that a lot of these workers that are out of the workforce, it turns out to be more temporary than permanent. That doesn't mean everybody's flooding back, but over the next 9 to 12 months, as folks begin to sort out, care needs for kids, or even seniors that they're responsible for, some of the COVID and health risks become a lot less acute. And some of the spending, some of the things that came onto people's balance sheet as a result of some of the stimulus programs, et cetera, as those things fade, I think we're going to see a lot more folks return to the workforce and begin to close that gap. But it's not going to look like it did before.
Yeah, agreed. And I would just add a couple of points. Some of the silver linings, while they may be painful, I read a study recently that middle class wages on an inflation adjusted basis are actually down 7% from what they were 45 years ago. And so sort of this wage pressure upwards helps to potentially start to close the gap between the haves and the have-nots, which I think would be terrific for our country and potentially help ease some of the political divide that we're seeing. I also think remote work can go a long way, where you don't have to live in New York or LA or Chicago to be able to have a high-paying, say, tech job. You could maybe move back to the Midwest, or where, the farm you grew up in. And with that comes your spending and purchasing power in those areas. So kind of economically redistribute wealth a little bit outside of just the major metro areas, I think might be a good thing for the country as a whole.
Yeah, and Holly, some of our older viewers are probably wondering, okay, the middle class, that used to be a wonderful thing in our country, and now we're lumping them in with the have-nots. So, but there's been a
But
concern.
that is the point, right? The middle
Absolutely.
class used to have, you know, one person could stay at home, you could have 2 kids, you could have a nice car, you could have a nice house. That's really hard to do now on one income.
Yep. So there's been a lot of concern about the disappearing middle class, and but again, you know, the techno-industrial revolution is not kind to some job categories of middle managers, for example. So we got to keep in mind that we have this other force, which is one of the most powerful forces of our generation, moving through here, even as all these other things boil the soup.
Yeah. The other
We
thing
actually had
I
a
might,
question come in, Holly, that I think is apropos here, and I think it's to a point that you were interested to make, is the idea that because of the technology innovation and other things, we may have a lot of these folks that are temporarily out of the workforce that may come back in other ways. You know, is that more entrepreneurial? Is that a different chapter of their career? Is it a different balance of, you know, contributing in ways that may not look like a traditional full-time job? And I think that that's
yeah, and
absolutely going to be the
I'm
case.
as a member of the boomer class, I'm going to also offer that many boomers, while they're technically quote unquote retiring early, will probably have encore careers, and they might become entrepreneurs. They might go back to school. They might, who knows what they're going to do, but it's hard for me to imagine some of the younger boomers who are still in their 50s having 30 or 40 years of just leisure time. So, and I think the other population that is potentially artificially lowering the unemployment rate because they're not looking for jobs right now are women, who are the ones I've read, as many as 3 million women potentially are the ones that are doing most of the caregiving, whether it's for parents, for kids, homeschooling. So until we get past and more stable with this Omicron variant, that's going to be the case. But it's important to raise that workforce participation rate in terms of just the economy and the GDP and the debt to GDP ratio that we were just talking about.
Yeah, and I hear that McDonald's is accelerating their development of the robot at the drive-through window, which my last couple of experiences at the drive-through window, I really hope they do that, because they haven't been very pleasant.
By the way, that's not an endorsement or a not endorsement of that particular fast food restaurant.
Yeah, exactly.
So the other point that we could make about jobs and labor is that because labor right now has some leverage, many people are sort of moving into higher paying jobs, leaving a hole, if you will, in that bottom rung. And with immigration being down about 42%, there just aren't enough people to fill those roles. And so that's an issue that we're going to have to contend with, I think, going forward.
Yeah, absolutely. And, you know, this has been a hot potato, frankly, with both political parties saying we need to do something about legal immigration. Now, again, a lot of differences of opinion on skill sets and not legal immigration, but legal immigration, they basically said we still need those immigrants. And you know, recently I've been talking with friends of mine who are on both sides of the aisle in Washington, and they say, "Oh yeah, we agree on this. We just can't figure out what to do with it." And
as per usual, right?
they got to figure this out. I mean, this is a serious problem. So, you know, I think it's good to talk about Elon Musk's very dramatic comment in December of last year that demography, this lack of babies happening in the world, the United States were a little closer on the amount of babies and number of deaths, but around the world, we have what are potentially shrinking populations. He called this the number one issue facing our civilization, not climate change, not a lot of other things. This is the number one issue. And okay, robots and automation over the next 20 years may help alleviate some of it. But the fact is that legal immigration is a very critical part for the United States. Japan and China, Russia too, but Japan and China in particular, do not have good immigration. And they are trying to figure out how they can solve that problem, because it is, in their minds, a clear and present danger to their economy. We need to solve it so it doesn't become a clear and present danger to our economy.
Yeah, 100% agree with that, Dennis. You mentioned something about technology doing some of the jobs at your local fast food restaurants, and that bodes really well for tech stocks, I would think. I know that tech stocks make up about 30% of the US market, and it's a much lower percentage. I don't know exactly what that is, PJ, but it's a lower percentage in international markets. How do you think that dynamic plays out?
I think we've seen it play out over the last couple of years, where technology stocks, both in the developed world and the emerging world, have done really well. And like you mentioned, the S&P is around 28%. Technology right now, that doesn't include some other names that have drifted into communication or some other area. But you look at the EFI, so that's the developed international market, and they're less than 10% technology. The largest sectors in the EFI are financials, industrials, consumer discretionary. And so a different mix of companies. And so we've seen the US tech heavy names, especially some of the largest ones in the US, have really been driving the performance of the S&P and the US stock market the last couple of years. On this chart, what we're looking at is periods when the US outperformed developed markets internationally versus when developed markets like Japan and Europe outperformed the US. And you can see we go through different phases, but the period of outperformance by the US coming out of the Great Recession has been pretty historic, going back the last 50 or so years in terms of the duration. The magnitudes only surpassed by the late 80s. And again, that was really driven by the Japanese stock market. The Nikkei had a wild last couple of years to the 80s. It's something that some people don't know, is that the Nikkei is trading today around 30% below its peak in 1989. So it peaked at the end of 1989. Here we are 30 years later, and it's still 30% below that amount. Again, it was our .com bubble on steroids, essentially, in terms of the valuations that people were paying for Japanese stocks back then. But really, when we get back to the US versus international today, like Haleh said, we are beginning to see some pressure on technology stocks. The NASDAQ really being one of the main benchmarks for growth names and technology names is in a correction territory, as it's down more than 10% from its recent peak back in November. What's driving that is a fear of higher rates are definitely putting some pressure on tech names for two reasons. When analysts or other investors are trying to come up with a value for a company, they kind of discount a future value based on expected earnings, and the size of that discount rate, the higher the discount rate, the more it takes the current present value down. And so with rates getting higher and people anticipating rates to move higher, that's hurting some valuations. There's also a lot of tech names, maybe not the largest ones, but there's a lot of tech names that are in the tech sector that are not profitable right now. And they have high debt levels. And so rising interest rates, and you're already not profitable in a pretty strong economy, is definitely going to be potentially a headwind. But really focusing back on US versus international on this slide, Stearns has said for the last couple of years, we think international will outperform the US stock market, and definitely been early with that call. But as each year the US has outperformed, it's made a larger gap between, when you look at valuations between the two areas. Currently, the developed market international stocks are trading at a 30% discount to where the US is when you look at the overall valuations. JT talked about earlier, the S&P price to earnings ratio in the US around 21 right now. When you look at, on a current PE ratio basis, when you look at international stocks, they're around 14. Historically, the US has been around 15 and the international has been around 13. So again, the the international markets are sitting near their historical average going back to the beginning of the century. The US is definitely above. Again, part of that being driven by the high growth tech names, which may justifiably have higher valuations. But the gap has become much larger in recent years. Also, for investors looking for dividend income, so ongoing regular income, the current dividend yield for international stocks in the developed world is 1.6% higher than what it is here in the US, where your dividend yield is now below 1.5% here in the US. International markets are closer to 3%.
Yeah, it's frustrating looking at this chart because we keep waiting for that international piece to outperform and give us something, because that is the highest potential growth area if you're starting at a lower base, right? But it's been 14 years. So maybe a rise in interest rates and the change in tech stocks will kind of trigger a change here.
Yeah, and I think another driver of this, of tailwind for the U.S. relative to international, has been, again, we mentioned it earlier, the strength of the U.S. dollar. The dollars continue to increase, and as that happens, the returns in other currencies, so Europe or Japan, when you translate their net U.S. dollar returns into U.S. dollars as a U.S. investor, well, if the U.S. dollar is appreciated during that year against their currency, that pulls their returns down in U.S. dollar terms. And so if we see that go the other direction and the US dollar faces headwinds and declines relative to other currencies, that is also a tailwind for international. One question we did have is what would happen to, I guess, the tech sector based on what comes out of Washington. There's been lots of discussions over the years about breaking up certain tech stocks. You know, I think when we're looking at what they're talking about right now with Build Back Better and corporate tax reform, and again, are there antitrust issues here with some of the big names? A lot of TBD. Again, gridlock is across the spectrum in Washington. If that continues, it's hard to see much being done on that front. But again, it's definitely being discussed, and it's definitely a concern potentially for some of the tech names. Although you never know if you break them up, as we broke up at the beginning of the 20th century, some large names. You know, the sum of the parts became worth more than the whole itself. So I think that will be determined in the coming years.
Yeah, I've seen more of the antitrust regulators from Washington on major media outlets in the last week than I've seen in the last decade. But again, a lot of those big tech companies pay a lot for lobbyists. So we'll see where all that goes.
Well, I appreciate all of the economic data that you guys research on an ongoing basis. And I know that feeds into what we do with our investment strategies. So for our viewers out there, we generally use this economic data and various data points to create scenarios going forward. We don't try to predict what markets are going to do. That would be a fool's errand, right? But what we do is create a base case, a bear case, and a bull case, and weight them by probability. And each one of those cases has various factors in it. And the reason for that is not because we're predicting, it's just so that we can be ready to pivot if any one of those factors come to fruition. And oftentimes, whatever actually does happen has elements of all the scenarios in it, or some of the scenarios. So we're never on point, but it does help us plan ahead as to what we might do if a certain event comes to pass. So we're going to take a few minutes right now to look at the various elements that we are considering as we built out our 2022 base case upside and downside scenarios. And so we're going to start with looking at some of the headwinds to the stock market.
Yeah, as we bring that up, I think, Haleh, there's quite a number of these that we've already touched on in some fashion. We've hit on inflation. It's clearly a headwind that could negatively impact the performance of companies and the valuations. We just addressed a little bit of the regulatory changes, whether that's more aggressive regulatory feedback from the current administration, or perhaps potentially the breakup of some of the technology companies, those sort of issues. That certainly would be a headwind for valuations. Corporate tax rates, again, at the moment, it doesn't appear that is highly likely. We all recognize, though, we talked about the debt issues long term, and so could this come back around? So that area may not be as much of an issue in the 2022 timeframe. Clearly, there's always great risks out there on the geopolitical front. Perhaps now they feel especially pertinent as we have been watching so much that the administration's trying to do to tamp down Russian aggression in the Crimea and region in the Ukraine. So hopefully that has effectiveness. But obviously, there's continued issues around China, whether it be more of their economic imperialism or direct, as you think about things like Taiwan. So they're huge geopolitical wild cards. Those are very difficult to handicap and work into any sort of an economic forecast. One that we haven't touched on yet is the considerations around insider selling and what is the message of that. So we are seeing so-called C-suite executives doing a lot of taking chips off the table, whether it's Elon Musk in a more dramatic fashion, but it's happening really across the spectrum in U.S. corporations. That is arguably healthy. Certainly, if we were advising them as clients, we'd be talking about deconcentrating their risk and spreading that out. But it also tends to be an indicator. It tends to be a reasonable, have some timing in the past as when this becomes more rampant, that we may be approaching the top in a market. So another data point to keep in mind. We've talked about the potential for Federal Reserve missteps being a big swing factor in markets in the coming year, and interest rates. PJ went through how that affects the valuation metrics for larger companies. And obviously the black swan. COVID originally was a so-called black swan. It was a huge, high impact, low probability event that you couldn't really see coming. You can never rule those out. Hopefully, one of the unfortunate positives of living through COVID is maybe we've created more resiliency. Maybe we've created a better ability to adapt as certain things come out of the blue, so to speak, in the future. So those are some of the headwinds that we have to weigh out as we think about our forecasts.
Thank you for that, JT. And if any of you saw me smiling while he was going through that, it wasn't because of the headwinds, but it was actually a hilarious comment from one of our clients who said, "This is all very interesting, but are we having a live Christmas party this year?" So is that part of our scenario planning?
I think the odds of that are well above 50%.
I hope so. Gosh, we miss it. We miss you guys out there. I mean, we really do. I look forward to getting back together and doing this in person like we typically do. But for the time being, Dennis, why don't you provide us with the tailwinds? And this time, if I smile, it's going to be because I'm happy.
Well, so one tailwind, we talked about the cash that consumers have to spend. Well, some of that makes its way into the stock market. What is interesting is that one of our top research outfits, Stratagas, they did an analysis of this, and they called the cash going into the stock market underwhelming compared to what it could be. So again, I think that's a potential tailwind. Earnings at the higher end of 2022 projections are anywhere between 8 to 12% right now. We are hearing a few folks say, there's a lot of good things going on, and maybe we'll be at the high end of that range, like 12% growth or better. As we have talked about over the years, earnings matter. In fact, over longer periods of time, earnings are the key. Short-term periods of time, you can have all other kinds of crosswinds come in. Number 3, no alternative yet to riskier assets. And that is a conundrum. And so, earlier today, I was on a call with one of the top bond managers of the world. And, they were talking about how people are just exiting bonds and perhaps not leaving enough for some risks that are out there. But the fact is that they're not going to provide good risk-adjusted returns, and a lot of the other things that we use in our portfolios are. Automation helping profit margins. One of the things that we are hearing from our networks is a couple of different pieces of this. One is that acceleration was mentioned earlier of technology and automation as a result of the pandemic. But part of it is also the fact that companies have recognized they need to do a better job of the balance of the human automation element. What I mean by that is not cyborgs where you combine technology and the person together, but working in teams and in tandem. And so major companies, again, I was on a briefing recently with one of the top companies in the world talking about their training and education program. We hear all the time, oh, if the government doesn't do this, if the government doesn't do that. Well, let's not forget that we are in an economy here in the United States in particular, but around the world, where the big companies are not asleep at the switch. Sometimes it appears they are, but they are moving very aggressively for training programs, retraining programs for jobs that have gone away, but new job career paths. And so again, I think that could be a significant tailwind. New, more flexible supply chains. Again, it was mentioned earlier that the workarounds companies are using are incredible, absolutely incredible. Textbooks will be written in major universities for the next 20 years on some of the things that have been done in the workaround category. Stock buybacks at record levels helps earnings growth. This is one of those areas that Warren Buffett a few years back thought that stock buybacks were the result of lazy management, who didn't have other good ideas for deploying capital. He's now become a fan, or at least not a naysayer, and does a little bit of that himself in Berkshire Hathaway. So that is a tailwind. And then anything to strengthen animal spirits or confidence, which would be a lack of bad news. We talked earlier about the demand-driven economy. This could be something to behold in terms of the consumer demand that is coming up. And then the power balance after midterm elections, we've gotten heads up from some of our folks that there may be a closer midterm elections than originally thought. And so time will tell what happens there. But I think the probability of further gridlock, like the probability of rain in many of the places we have clients right now, is pretty high.
Thank you for that. I mean, this is confusing, the tailwinds versus the headwinds. So let's take a look at what we did with all these facts and data points and issues to contemplate in terms of coming up with our base case. And for that, I'm going to ask PJ, who is the co-head of our investment committee, to give us the base case for 2022.
And I think, Holly, before talking about our outlook for 2022, everybody always asks what last year looked like. What did we say last year? Last January or early February, we did a live chat. And back then, what played out during 2021 looks a lot like our bull case. When we think about the GDP growth is going to come in above 5%, which is what we said. We were right on the U.S. 10-year Treasury being 1.5%. It came in the end of the year 1.52, and the fact that the Fed would not raise rates. So those three things we did pretty well on the bull case, and things played out like that. But when you look at two of the other things we showed on that slide last year, we showed the expected return for the S&P. In a bull case, we were thinking mid teens. So again, almost double that for the S&P, up almost 30%. And then on inflation, we did not expect or discuss inflation being above 5%. So with that, and with Holly's earlier caveats, so again, we use this for scenario planning, looking at those tailwinds and headwinds, and that many times what actually plays out is a combination of our base or bull and bear cases. But looking at our base case here, we put a probability of 45% on it. So again, higher probability that something other than base case happens. But we expect U.S. GDP growth to come in around 3.5%, again, cooling off from where it was last year, but still pretty strong growth, again, much higher than what the CBO is forecasting long-term for the U.S. We think rates will rise this year, and they're already doing that in anticipation of the Fed raising rates. Your longer-term bonds here at 10-year yields ending above 2%. As I mentioned earlier, we've already come close to 1.9 this year and pulled back a little bit, but we're still 1.8 to 1.9% right now. So not too far to go to reach 2%. We do think US stocks will experience increased volatility compared to 2021. We've shown a slide a lot in the past, showing the average drawdown per year in the US stock market over the last 30 so odd years. And it's been in the mid-teens, again, 14% plus on average. That did not happen during 2021. It was a very low volatility year for the stock market. We do not think, and the first few weeks have proven that we'll see low volatility this year. We do expect volatility to pick up, but we do think in our base case that US stocks will achieve mid-single digit returns and the international stocks outperform the US, aided by headwinds to the US dollar. We think unemployment will remain low. Again, we talked a lot about that earlier with JT and Holly about what the current labor market looks like. We are below 4% currently. We think, maybe it ticks up a little bit towards 4, but again, that unemployment will remain very low this year. And that CPI remains elevated compared to the last decade, but cools off from where it was in 2021 and comes in at between 3 and 4%.
Great, thank you. So we're giving this a 45% probability. Let's look at our bear case. If JT, can you walk us through that, please?
To say I'm glad to, but I certainly will, yes. So we always have to consider the possibility, obviously, that things don't go as well, particularly after such a strong period of time as we've had recently. So our bear case, we put about a 30% probability on it. What was interesting in our discussions was you could say that this really could arise from either end of the spectrum. Is the economy too hot and the Federal Reserve has to take too much action and shut things down, for instance? Or do we have an unforeseen recession or perhaps something related to another variant on the COVID side that drives us toward a recession? So in either case, you could see a bear case occur. In that scenario, we would suggest that GDP growth would come in much more soft, a lot less robust than is built in the base case. The Treasury rates become more volatile, but probably it could really swing to either direction. It might go a lot higher if the Federal Reserve has to address inflation, or conversely, if the economics kind of break down towards recession, you could see actually those rates have to fall backwards. Again, both of those would cause stock pullbacks, and that could necessitate or could cause stocks to pull back in the double-digit range. Keep in mind, we didn't really address this directly, but the average year has about a 14% drawdown in stocks at some time during the year. We've had very benign volatility over the last year and a half, going on 2 years now since COVID erupted. So just a return toward, quote, normal volatility might feel a lot more acute. And so that double-digit 15 to even 20% drop. Unemployment could remain low, but creep higher. And some of this might be folks coming back into the labor force. We talked about that participation rate being down. And so as folks return to searching for work, because they're not counted if they're not searching, you might see that unemployment rate begin to creep back up. And inflation still remaining relatively high and relatively problematic at around 4%. So we try to synthesize this in. We talk about 2 different causations for it, but in either case, the risk is about a 30% probability of stocks having a materially down year.
Well, let's hope that doesn't come to pass. However, it's good to consider and be ready to act as we see some of these things potentially come to fruition. So Dennis, why don't you take us through our bull case?
Sure. And the good thing for everybody to remember is that if you add the base case and the bull case together, what this is all suggesting is there is a 70% chance of things going okay or better, and a 30% chance that the turbulence will get rough. Put on your seatbelts. And so, in our upside case, GDP growth comes in around 4.5%. And by the way, this is over inflation. This is the real GDP growth. So if you add inflation in there, that's, it's pretty robust. Treasury rates, they rise as a result of a more robust economy. Again, not rising radically compared to history, but radically compared to where we've been in the year above 2%. Federal Reserve follows through on raising rates, again, maybe it's not just 3 in this scenario. It could be more rate hikes in this scenario. U.S. stocks move higher on strong earnings growth and still finish the year up low double digits. And international returns are competitive with U.S. stocks. And so again, the sloppy start to the year for U.S. stocks might make you wonder about this. But again, I think there's a lot of companies that are going to have upside surprises on earnings in 2022. Unemployment remains low, and then inflation cools from some of the numbers that we saw at the end of 2021, coming in around 3%. Now, again, this is one, just like JT was mentioning, how the downside case could happen from a couple different directions. If this upside case gets too much money chasing too few goods, and the money supply and velocity of money in our economy gets moving really fast, well, that's going to put upward pressure on inflation, and maybe we end up higher. So again, I think inflation continues to be around. It may not be the hyperinflation in the 1970s, but it's at a high enough level to get our attention and get the attentions of C-suite executives on a lot of the companies we invest in.
Thank you for that. Now that we have covered these various scenarios, let's close the loop, please, to our investment committee on how this impacts our investment strategy going forward. So I know personally, I have many clients who are asking questions like, in most of these scenarios, you've got interest rates going up. So why would I even hold a bond? So talk to us about what it is in terms of asset allocation, why bonds, are we under overweight bonds? What are we using as substitutes? And generally in a highly volatile market, which we're kind of predicting, what is the best strategy for our clients?
Quite a question there, Holly. It's definitely one that we get more and more, particularly around the bonds. I guess I'd start by saying, going through those scenarios like that, hopefully it's not an exercise in futility, but it's certainly an exercise in humility. We know that none of those scenarios are going to play out exactly the way we portray them, but hopefully thinking it through, we can adjust and integrate as we see events transpire. I think answering that question really starts with our investment philosophy, which really begins with effective global diversification, having well-diversified portfolios, all of those eggs spread across lots of different baskets. And that's one of the principles that undergirds what we do. Another is, we want to be about preserving and enhancing for our clients. We don't have to hit the ball out of the park. We want to kind of keep things between those guardrails. So what to do with bonds in a likely rising interest rate environment? Again, first off, we can't rule out that there could be some surprise shock that would cause things to go in exactly the opposite direction. And that's a big reason why we keep the ballast of bonds in place, at least to a degree. We don't know what tomorrow may hold. Nobody foresaw something like COVID arising. That obviously reversed everything that had been going on previously in the economic and financial markets. So we're not predicting that, but we do think that we need to have that as a safeguard. So whenever stocks take it on the chin, and they will, we don't know exactly when or for what reason, very likely bonds will at least hold up, drop less, and may even directly add value. So that diversification benefit is significant. I might make a case that in this past year, some of the work we did in the bond space was some of our best value add. We chose to not just hold the kind of plain vanilla traditional bonds that do see the most erosion in their price when interest rates are moving up. We did a fair amount with Treasury inflation protected securities. We did a fair amount with more flexible corporate multi-sector managers. That may or may not be the case going forward, so that's not an investment recommendation, but we were actually able to squeeze out a better return from bonds than what we otherwise would have experienced. The other big thing that we continue to do is to substitute away from traditional bonds toward other asset classes like commodities, like real estate, like real assets. And so if we can reduce our exposure to bonds, we're typically in most portfolios a good deal light, maybe perhaps half of the normal weighting to bonds. And we're using a lot of those other components where we've been able to generate good, upper single digit type rates of return. So that replacement has worked out well. The long-winded answer, start with diversification. It's hard to completely exclude any asset class at any time because you can't predict what's happening next. But then being active to think out and to seek out other ways to attain a similar return, but with better diversification, less correlation with the two major asset classes of stocks and bonds.
And I know too, for some of our higher net worth clients, we continue to layer in other alternatives, private alternatives that that make sense as a way to diversify out of just public markets as well.
Absolutely. And I'd say, obviously, a lot of that comes, some of that comes on a client by client basis. How much can they afford in liquidity? Are they at a level where some of these things become available to them? But yes, more and more we have more traditional fund-based or semi-liquid interval type funds that allow us to address those types of asset classes in a broad way for all clients.
Great.
I know that's a big part of where PJ puts a lot of research.
Yeah, I was going to say, this has been an extraordinary past year. Some of the things that PJ and Glenn and their team have been analyzing, very small percentage of it actually makes it onto the field of play, but we've been looking at a lot of really interesting things. And there's been a democratization of some of these asset classes, which means that it's not just our ultra high net worth and high net worth clients that can afford some of these other alternatives. So that accelerated in 2021, and there's good reason to believe that it'll continue accelerating in 2022. So, that gives us more tools to diversify. And some of these tools have multiple benefits, including inflation hedging protection and good downside risk hedging protection.
That's right. I know the minimums have come down for some. The lockup period is a lot lower for some. So I think this will become more prevalent, more available to more of our clients as needed and appropriate. Any closing thoughts or words? Did we leave out anything, guys? Or shall we let we're the only thing standing in the way of dinner at this point. So okay, then let me just conclude by saying that we've had a tremendous return scenario here for some time. And so buckle up and hold on, because we may see some volatility this year, and it's important to keep it in perspective. As was mentioned by PJ, the average downside scenario is 14%. We just haven't seen that in a while. And so I know that we saw that with COVID, but that wasn't a typical scenario. So we expect more volatility this year, and this is nothing that you should be alarmed by. If you're concerned by volatility, please contact your advisor and we can look at adjusting potentially your risk tolerance.
Well, and I think it's important to mention, Holly, that most of our diversified portfolios, because of those things we were just talking about, if the US stock market's down 14, we won't be down 14. So
that's right. We were down about half as much in our 60/40s in March of 20. So that's significant. So we really try to smooth out the ride, but doesn't mean it won't be volatile, right?
That's right. Well, the old adage about the heat in the kitchen if it gets too hot, and we try to keep the heat from getting too hot for our clients.
That's right. All right, everyone. Thank you so much for your time and attention. And thank you, panelists, for your great research and thoughts. And we look forward to seeing you all soon in person.
And keep those cards and letters coming, because we use them for our frequently asked questions for our chat. So let us know what you're thinking. What are some of the key questions that you have for us?
Thanks, Phil.